First off, some of you who have been regular visitors to our monthly insight would be familiar with the chart on the left. This basically talks to the dominance of the US within the global equity market. So you can see the weight of the MSCI USA as a percentage of the MSCI All Country World Index. And you can see just at the end of the global financial crisis, the weightage of US in the All Country World Index was about slightly above 40%. Its peak prior to that was about 54-55%. And then in the last 15 years, it has risen to almost 2/3 of total market cap, almost about 64-65% of total market. Now, not only has the US outperformed global equities, if you then look within the US market, and of course, we are looking at a slightly different index on the right-hand side, which is the S&P 500, what you find is that the Magnificent Seven, as they are called, are now accounting for over 30% of the US S&P 500 market cap. And you can see what the weightage of the Magnificent Seven was going back a decade and how it has almost gone up 6x over this period as a percentage of total US market cap, or at least market cap of the S&P 500. For those who are not aware, the Mag 7 stocks are Alphabet, which is the parent company of Google, Amazon, Apple, Meta Platforms, the parent of Facebook, Microsoft, Nvidia, who is now the world's most valuable company, and of course, finally, Tesla. So within the US, it is this Mag 7 which has outperformed the markets very significantly. And in fact, if you take the share of S&P 500 accounted for by the top 10 companies, this is a data point you can see over many decades. The weightage of the top 10 names in the S&P 500 today, which is almost about 35-36%, is one of the record high concentrations which has happened in the US marketplace. So moving on from that to the next slide, let's dive into the Mag 7 a little bit more. On the left-hand side, what you see is the earnings growth of the Mag 7 and the earnings growth of the S&P 500, excluding the Magnificent Seven. And this is the quarterly earnings number on a year-on-year basis. And you can see the numbers all the way from Q4 of 2022, all the way up to the estimated number for Q2 of FY25. And you can see those numbers in the blue bars. The blue bars is the Mag 7. And you can see that coming out of the pandemic, the earnings growth accelerates to 54-55%. It's slowed since then, but it's still running at about 24%. The interesting thing is that earnings growth in the US has not been broad-based. So which is why if you look at the earnings growth of the S&P 500, excluding the Magnificent Seven, you'll find that even all the way into Q1 of 2024, the remaining 493 companies in the S&P 500 in aggregate were struggling to even break past the 5% level of earnings growth. It's only in the last 5 quarters, including the estimate for Q2 of FY25, that the remaining 493 companies in the S&P 500 are now averaging about 5 to 6% earnings growth on a year-on-year basis. So the earnings gap is reducing, but I would say more importantly, this just tells you that earnings growth has not been widespread in the US market. The US market performance and earnings has been held up by a narrow set of companies. Now, what are these narrow set of companies doing? As you're aware, this narrow set of companies, most of them are the hyperscalers. So, hyperscalers are the companies who are investing very aggressively in cloud infrastructure and computing infrastructure, essentially to ensure that they are able to meet the rising demand for computing demand on account of the development of artificial intelligence. So on the right side, when we say 4 major US hyperscalers, we are referring essentially to Amazon, Alphabet, Meta, and Microsoft, because these are the companies who are investing in building the cloud and computing power to power the artificial intelligence revolution. Now, if you look at this, what this chart is plotting is CapEx as a percentage of revenue. And you can see that from 2014 all the way till about 2019, CapEx as a percentage of revenue is hovering between between 8 to 10% of their revenue. But then coming into the pandemic, the investment in cloud takes off. And then starting 2023, the investment on account of artificial intelligence starts to take off dramatically. And you see the, capex as a percentage of revenue go from about 11% to 22% in just 2 years. Now, these four hyperscalers are the companies which historically had low capital intensity, except of course Amazon, and at the same time they threw up a lot of cash. Now, interestingly, they are actually becoming the capex drivers, not just of the US corporate sector, but also of the economy. And it is this capex which is actually ensuring that the US economy does well. But when you do this kind of capex, the question you have to ask yourself is, will the returns be commensurate in terms of, will this capex lead to a high return on capital like their core existing business historically enjoyed? Or is there a risk of lower returns, or for that matter, negligible returns? So the market is currently rewarding these companies for capex, but I think the outcomes in terms of what actually happens in terms of the returns the companies are able to earn from the capex is still unknown, and therefore this is a story that we will have to watch very carefully. History is replete with examples of companies over investing in the early phases of a boom and then actually suffering dramatic either impairment of capital or a significant reduction in return on capital. Still very early days. I don't have a forecast of how this will go, but history is a reminder that we should be careful about extrapolating the returns on capex at a very early stage of the cycle.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.